This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and start to have a look at a couple of the numerical examples. This video here will go through the first two examples, looking at the held for trading financial asset and also the available for sale financial asset, because their recognition and measurement is very similar. The next video we'll look at your amortized cost methodology, which is a whole separate world. Okay, so leave that for the time being. So first example, it says there, explain how this should be initially and subsequently accounted for in the financial statements. So statement of financial position, statement of profit or loss. You could talk about cash flow if you want, but I'm not too worried. Of Robbie. So it says that Robbie purchased a trade investment for $20 million. So that's going to be, isn't it, a financial asset? We intend to sell it in the near future, which is why therefore classified as held for trading, isn't it? Okay. Transaction costs of 0.5 million were incurred, as it is fair value through profit or loss. Those transaction costs go immediately to profit or loss, don't they? Okay. So that's everything about the initial. Subsequently, it had a value of 60 million. So that's at the reporting date. So we will need to get it from its 20 to its 60. And then soon after, it was then sold, wasn't it? So when we sell it, we get a profit or loss on disposal, and we will need to show how that works there. Okay. So what you've got, pardon me, is if we think about what happens on your initial recognition, you are going to debit your financial asset, fair value through profit or loss, held for trading. Is that there with $20 million? You debit your statement of profit or loss with 0.5, because they are your transaction costs, and remember they get expensed immediately through profit or loss, don't they? The credit is then to your bank, isn't it? And you have paid, is it 20.5 million? Okay, there we go. Subsequently, so is that at the year end or your reporting date? You have there, don't you, the fair value is equal to $60 million. So your fair value originally was 20. It's now at 60. So you will need to debit your financial asset, won't we, with $40 million, because that debit increases the asset from the 20 to the 60. Whatever you do, don't debit it with 60, because it was already there at 20, wasn't it? The credit is there to the statement of profit or loss. Credits are good in profit or loss, so that there is your gain of 40 million, isn't it? Okay, excellent. So that's at year end. What do we go through there and do on disposal? Well, we've sold that financial asset, we de-recognise it, and we have received cash, is it, of 120 million. So I debit the bank with 120 million. The financial asset I reduce, so I credit it with its previously known value, which was 60, wasn't it? Because the last time I fair valued it, we fair valued it up to 60. And then the balancing figure is the statement of profit or loss. That's, if you like, a profit on disposal, which is there, is it as the 60 million. That's it. It can't get any more difficult than that, because that is testing all of the rules that we know. Okay. Next one is looking at your available for sale. So similar type of situation. It wants to look at how we deal with it both initially and subsequently. Again, in the financial statements, position statements, performance statement being profit or loss. Here it says we purchased a trade, an investment that we intend to keep for the long term. So it's not held for trading. It's in that dumping ground, the default category, isn't it? Available for sale. It cost us 50 million, and we had 1 million of the transaction costs. It's not held for trading, so therefore they are not expensed, are they? Those transaction costs will be added to that 50 million initially to give us a total cost of the financial asset of 51. Again, once we've got that, we then need to increase it up to 80 at the year end, and then we dispose of it for 90. The key bit that you've got there is when you do revalue it up to the 80 million, you need to think about where the gains and the losses go. Where do they go? Yeah, excellent. You're on the ball today, folks. Other comprehensive income. So if we go through that and look at it initially, then what you've got there is that you debit your financial asset as available for sale. So we can abbreviate that to AFS. Is that there at 51 million? And I credit the bank as well with the 51 million. Okay. Subsequent, so at the year end, it goes through there, doesn't it, and told me that it was worth 80. So it has a fair value at 80 million. So I need to get it from 51 up to the 80, don't I? How much is that? 29, is it? 71, 80, yeah, 79, yeah, 29. So what we've got there is I debit my financial asset because I am increasing the asset from 51 up to 80 by 29 million. And the credit that you have doesn't go to profit or loss. It goes to other comprehensive income. So that bit at the bottom of your statement of profit or loss and other comprehensive income for those unrealized gains and losses, isn't it? Okay. So you credit OCI with 29, and then that would feed into the statement of financial position through your other components of equity. What then happens, a little bit trickier, I suppose, when we come to look at your disposal. If we go through there and look at the disposal, the proceeds that we got are that we debit the bank, is it there, with 90 million, isn't it? If I've debited the bank with 90 million, I need to credit my financial asset with 80 million because that's what it was previously valued at. So that's what I remove. And then I credit my statement of profit or loss with a profit on disposal of 10 million. Okay. However, what you've got to go through and think about there is that stuck within your reserves is this balance, is it, of 29 million. So what we do is a process, I think we refer to it as recycling. That's like a buzzword, isn't it, of this current century, recycling. It's important as well. In that what we do there is that we debit our reserves. So here that would be your other component of equity with the 29 million. And then you will credit your retained earnings with the 29 million, because that gain that you made of 10 on the disposal has now ensured there that you realise those previously stored up gains and taken them from your other components of equity where they were stored up and now transferred them to your retained earnings. So does that total, is it 39 million in total that we have as a profit on the ultimate disposal of the asset? Okay, there we go. Have a look for some of the examples in the revision kit, because I think you should find those quite to your liking with the numbers. And if you do get stuck, then yeah, fire away on any of the questions on the forum. So hopefully you're happy with those earlier examples on held to maturity financial assets and available for sale financial assets. We're now just going to move it on to look at held to maturity. Remember, held to maturity, or even loans and receivables, are valued initially at fair value plus transaction costs, and then this amortized cost methodology. So let's go through and explain what it's all about using the example. So here it wants us to explain how it is initially and subsequently accounted for in the financial statement of Steve. So we know that initially it will be accounted for at fair value plus transaction costs. So how much did we pay to buy this financial asset? So it says Steve buys a redeemable 4% $10,000 bond. So the 4% there, remember, is your coupon rate. And that's the amount that you promise, or you are promised to be paid under the terms of this bond. And you will be paid 4% on the 10,000, which is the par value. Okay. You will get the 4% on the par value every year over the life of the bond, which is in 5 years. And as it is a redeemable, you will also get the par value as well. Okay. It's the accounting treatment that's tricky, because the bond cost us 9,155. So that's the amount that we paid. So if we're looking at our initial treatment, then what we're going to do is we're going to debit a financial asset. Here it's HTM, held to maturity, as we have the intent to keep the bond until its maturity date. There are fixed and determinable payments. It is as well a traded bond. It has a market value, let's so say, and the amount that you recognise there is a debit of 9,155. There are no transaction costs. The credit is the amount that we've paid, which is the bank entry of 9,155. Subsequently, forget about any amortized cost element. What's going to happen there is subsequently we are going to receive the coupon rate of interest on that bond, aren't we? So subsequently, every year we will receive some cash. So what's going to happen there is that we will debit the bank, isn't it? And we debit the bank and we will credit the financial asset, because the coupon interest that we receive is a partial repayment of the debt that we have invested in. The amount that we are going to receive is 4% of the 10,000. Okay, so is that there at 400, isn't it? So I debit bank, credit my financial asset with 400,000. So initially I increase the asset to the 9,155. I reduce it every single year by the 400. but it is going to be redeemable, isn't it? And it will be redeemable at its par value. So subsequently, what also happens there is that I will need to debit my bank with the 10,000 because that is what it is redeemed at, and credit my financial asset with the 10,000. Again, reducing the financial asset by 10,000, but we've got a bit of an issue, haven't we? The financial asset in 5 years' time will not be at 10,000, will it? We have reduced it every year by the amount of interest, coupon interest, that we have received. So what we have to do there is that the interest income that we take to profit or loss to get the asset from the 9155 to the 10,000, we're going to have to use this 6%, okay? Because what we've got essentially, if we piece it all together, is the 9155 is the amount that we paid. So we paid 9155, didn't we? The amount that we have received will be 10,000, won't it? Plus 5 years at 400. So that there is 12,000, isn't it? Okay, we paid 9155. The amount that we receive is 12,000. So the difference between the two is that 2,845. That, ladies and gentlemen, will be our interest income that we need to record through profit or loss. We're not going to split it over the 5 years equally. We want to apply the matching concept, and essentially that 2,845, we apply 6%, because in substance that is the rate of interest on the loan, okay, on the investment that we have made. Yes, we get 4% every single year, but we also get a little bit of capital growth because we paid 9155 and that grows to the 10,000. So we use that 6%, which is referred to as your effective rate. And that effective rate is always going to be higher than that coupon rate because you will redeem the bond at a higher amount than what you paid. Okay, so it's all about spreading the 2,845 over the 5 years based upon that 6%. So how are we going to go through and do that? Well, we're going to draw it up as a table. So what you've got there is we can look at, is it year 1? Let's just move that down a little bit further so I have space at the top. I'm going to start off with my brought forward. I'm then going to look at my interest income, which is based upon your 6% coupon rate. You then look at the cash that you have received every year before you then look at the carry forward. Again, the cash received is the coupon rate multiplied by the par value. I can't emphasize how important that is. Now let's go through and just see how the magic pieces itself together. So we start off, don't we, with the 9155. That's the value of my financial asset. If I charge 6% on the 9155, does that give me 550? That's the interest income. And that interest income will be there taken to the statement of profit or loss. Don't worry about the journal entry at this moment in time. Okay, we'll talk about that at the end. But that 9155, we add the 5550. We then go through there and deduct the cash received. Is that as 400, which gives me 9305. Once you've done it for 1 year, you're away for year 2. 9,305. 6% of that is 558. And we deduct the same 400 because that is the amount that has been promised to us every single year. When we initially entered into the contract, it said we will be paid 4% of the 10,000 par value. Does that give me the 9,463? So those carry forward figures are what you see on the statement of financial position. It gets a little bit tedious because if you can do it for the first 2 years, you can do it for the next. You're unlikely to do it correctly because you're under pressure within an exam, and you're unlikely to be asked to do it for all the years. 1 is usually sufficient. Year 4, what have we got? 9,631. 6% of that is that 578. Deduct 400 gives me 9,809. So as you can see, every year the asset is steadily increasing and getting closer and closer to 10,000. I take the 9,809. I think the interest income is 589. I deduct not just the 400 in the last year, but also the 10,000 because that is what I receive at the end. And that comes down to, I'll put it in inverted commas because I don't think it's exactly nil, is it? Okay. The reason why is that there is a little bit of rounding here or there, but it's pretty close. Okay, so don't stress too much about that. What I like as well is that if you were to go through, and again it will be a little bit of rounding, if you were to sum up those totals for the interest income, you should come to, is it 2,845 or somewhere within that ballpark. Okay, don't stress about a couple of digits either way. That's it. The only bit that I suppose I can add is how do we then deal each year with that interest income with regards to a journal entry? Well, you are going to, in year 1, debit the financial asset, is it with the 550, because you are increasing your financial asset, and then you will credit your interest income. That credit to interest income is in the statement of profit or loss at 550. Okay, there we go. How does that get examined? Gets examined in all sorts of ways. It could be the easiest way and just ask you to work out the interest income for a particular year. It could ask you to work out the financial asset at the end of a particular year. The most challenging one that you will find is whereby they have accounted for the investment in debt incorrectly, and you need to rework it to get the correct entries to remove their incorrect entries. Sends a shiver down your spine, doesn't it? So don't worry about that type of question. Make sure that first of all you understand this amortized cost methodology, and then once you do, then start practicing some of the questions, bearing in mind that they are some of the more difficult questions that you are likely to encounter. Other than that, that's it for your financial assets for now. I'll see you on the opposite side with your financial liabilities in the next set of videos.